Have you ever wondered why someone with $1 million in their bank account still feels uneasy when they walk through a grocery store or look at a utility bill? It sounds like a contradiction, but in the year 2026, this is the reality for thousands of people across the country. The truth is that $1 million does not buy what it used to 10 or even 5 years ago. Because of the inflation we have seen recently, the purchasing power of $1 million has been quietly eroded, leaving many people feeling like they are standing on shaky ground, even though they hit a major milestone. But there is something even more dangerous than inflation, and it is something most people completely overlook. Warren Buffett, one of the most successful investors to ever live, believes that your success has almost nothing to do with how smart you are or how well you can pick a winning stock. He insists that raw intelligence is not the secret to building or keeping wealth. Instead, it comes down to one specific quality that he calls temperament. Buffett has worked with some of the brightest minds in finance, including Ivy League graduates, top analysts, and famous economists. Yet, he has watched many of them fall flat on their faces when the market gets messy. The reason they fail is not a lack of knowledge, but a lack of emotional stability. They do not have the temperament to stay calm when everyone else is panicking. In this discussion, we are going to look at why your emotions are the biggest threat to your retirement and how you can adopt the mindset of the world's greatest investor to protect your future. When we talk about temperament, we are talking about the ability to remain rational when the world around you seems to be losing its mind. Most people think they need a high IQ to succeed in investing, but Buffett famously said that you only need to be reasonably smart. You do not need a 160 IQ or a master's degree from Harvard. In fact, being too smart can sometimes be a disadvantage if it leads to overconfidence. When people believe they can outsmart the market, they start taking risks they do not understand. Think about the story of a company called Long-Term Capital Management. This was a massive hedge fund run by Nobel Prize winners and the most brilliant mathematical minds in finance. They had complex models that were supposed to make their investing bulletproof. But when the markets moved in a way their computers did not predict, they did not stay calm. They panicked, they doubled down on risky bets, and eventually, the entire fund collapsed. It was not a failure of math, it was a failure of temperament. While those geniuses were losing everything, Warren Buffett just kept doing what he always does. He stayed calm, stuck to his process, and waited for the noise to die down. That ability to wait is perhaps the rarest trait in the world of finance today. We live in a world that demands instant results in fast growth. People want the hottest stock tip or the quickest way to double their money because they feel they are running out of time. But Buffett has been saying for decades that the stock market is simply a device for transferring money from the impatient to the patient. That hits hard because it is so true for the average person approaching retirement in 2026. Most people do not fail because they choose bad companies to invest in. They fail because they cannot sit still. When the market takes a dip, which is a completely normal part of the cycle, they feel a knot in their stomach. They see the red numbers on their screen, and they feel a desperate urge to do something, anything, to stop the pain. So they sell at the bottom, right after the damage has already been done. Then, they watch from the sidelines as the market recovers without them. By the time they feel safe enough to buy back in, the prices are high again. They end up buying high and selling low, which is the exact opposite of how wealth is built. JP Morgan recently ran the numbers on this behavior, and the results were shocking. They found that if you stayed fully invested in the S&P 500 over a 20-year stretch, you would have earned a solid return. But if you missed just the 10 best days of the market because you were trying to time the dips, your total return dropped by half. And here is the kicker. 7 of those 10 best days happened within just 2 weeks of the 10 worst days. This means that the recovery usually happens exactly when things look the most hopeless. If you are not there because you lost your cool, you miss the very gains that make retirement possible. He has owned shares in companies like Coca-Cola since the 1980s. He did not buy them for a quick flip or to impress people at a party. He bought them because he believed in their long-term value and then he let time do all the heavy lifting. That is what compounding is all about. But compounding only works if you have the discipline to not interfere with it. Patience is boring, and it does not make for exciting headlines on the news. But real wealth is not built in months. It is built in decades. One of the biggest mistakes people make as they approach their 60s is chasing the next big trend because they feel they started too late. They see others making money in speculative assets, and they feel a sense of envy. Buffett once said that it is not greed that drives the world, but envy. When you see your neighbor or a friend making money faster than you, it is tempting to abandon your plan. You might think you need to take a big swing to catch up, but that is exactly how people lose their life savings right when they need them the most. Buffett avoids this trap by staying focused on risk instead of just returns. His number one rule is never lose money. And rule number two is never forget rule number one. This does not mean he never sees his portfolio go down in value. It means he does not take bets where he could lose the principal amount entirely. He keeps a margin of safety and stays within what he calls his circle of competence. If he does not understand how a business makes money, he does not buy it, no matter how much people are talking about it. This emotional control allows him to see opportunities where others see disasters. Think back to the financial crisis of 2008 or the market swings we saw in 2024. While most investors were pulling their money out in a panic, Buffett was writing checks for billions of dollars. He was buying when everyone else was selling. He famously said to be fearful when others are greedy, and to be greedy only when others are fearful. That sounds easy in a book, but it is incredibly hard when it is your own money on the line. It takes a specific kind of temperament to look at a crashing market and see a clearance sale instead of a tragedy. If you want to be a better investor in 2026, you should focus less on gathering more information and more on managing your own reactions. The world is noisier than ever before. Your phone is constantly buzzing with alerts about the latest economic crisis or a new market bubble. The media makes money by keeping you in a state of constant anxiety, but an investor needs the ability to ignore the crowd and stick to their own game plan. Without discipline, even the best strategy in the world will fall apart the moment the pressure hits. Another major hurdle for people today is the difference between net worth and investable assets. Many people reach their 60s and realize that while they are technically millionaires because of their home value, they are actually cash poor. They have equity locked in their walls, but they cannot use their kitchen cabinets to pay for medical care or travel. This creates a different kind of stress. It makes them feel protective and fearful, which often leads to bad financial decisions. They might try to draw too much from their smaller retirement accounts, or they might get desperate and look for high-risk investments to bridge the gap. Buffett's approach would be to stay conservative and focus on what provides a steady flow of income. He values cash flow over paper wealth. He wants assets that work for him every single day. If you have $500,000 or $1 million today, the best thing you can do is let it keep growing. The math of wealth is exponential, not linear. It might have taken you 20 or 30 years to save your first $1 million, but because of the power of compounding, the second million can arrive much faster, often in as little as 7 or 8 years. This happens because you are no longer the one doing all the work. Your money is doing it for you. Imagine a portfolio that earns a 10% return in a good year. If you have $100,000, that is $10,000 in growth. It is nice, but it does not change your life. But if you have $1 million, that same 10% return is $100,000. That is a full salary earned without you lifting a finger. That is the tipping point where your money starts working harder than you ever could. But to reach that point, you have to stay in the game. You have to resist the urge to spend your capital on things that do not provide a return. In 2026, it is easier than ever to spend money on branded clothes, luxury cars, or overpriced vacations that we do not even really enjoy. We buy these things to look successful, but they actually push real wealth further out of reach. Every dollar you spend on a status symbol is a dollar that cannot compound for your future. Buffett lives in the same house he bought in the 1950s. He drives a modest car and eats simple meals. He does not do this because he is cheap. He does it because he knows the value of a dollar that is allowed to grow. He understands that real freedom is not about what you own, but about having control over your time. If you have to work a job you hate because you have a massive car payment, you are not free, no matter how much you earn. Financial independence is the ability to wake up and decide how you want to spend your day. It is the power to say no to things that do not fulfill you. And that freedom is built on a foundation of temperament and patience. As we look at the remainder of this year and beyond, remember that market drops are completely normal. They are the price of admission for the long-term gains that stocks provide. If you can look at your portfolio during a downturn and not feel the need to sell, you are already ahead of 90% of other investors. Create a plan that makes sense for your stage of life, write it down, and then commit to it, no matter what the news says. Automate your investments so you do not have to make a decision every month. Check your accounts less often so you are not tempted to react to small fluctuations. And most importantly, remember that you are building a future for yourself and your loved ones. That future is worth more than any temporary thrill or any moment of panic. The edge that Warren Buffett has is not a secret formula or a special computer. It is his ability to keep his emotions in check. If you want to invest like him, do not just look at the stocks he buys. Study the way he thinks. Copy his mindset, his patience, and his unwavering discipline. If you can master your temperament, you can navigate any economy and any market cycle. Wealth is a marathon, not a sprint. Stay the course, keep your eyes on the long term, and let time work its magic. Your future self will thank you for the calm decisions you make today. Take a breath, trust the process, and stay patient. The path to financial peace is closer than you think. It all starts with how you choose to act when the world tells you to panic. Choose logic over fear. Choose patience over greed. And choose a life of freedom over a life of status. This is the way to true wealth.